Good to see everyone. Nice to be here with Raj Dante. I'll introduce our extraordinary panel. We only have 3 people, not like 30 people, though, right? We have 25 minutes, so we're going to be, we're going to 30 minutes, get through this quickly. So I think all of you who are here know that digital transformation, digital assets made a lot of progress in 2024. And I think Cecilia's comments listing out all the major projects, there's a lot. I have about 10 on my list, like Agora, Nexus, Bridge, Mandela, Rialto, Stripe buying Bridge earlier this week. And then, you can see for the first time that digital assets are actually moving outside of the crypto ecosystem into some real world use cases. And I would describe it, there are lots and lots and lots of reasons, use cases. I break them into 5 categories, which are cross-border payments and remittances, treasury management, which includes working capital optimization, risk management, trade finance, programmable payments, which is a big aspect of this, payroll, which is really a great use case, and then OTC, security settlement, and funds management and financial inclusion. So those 5 capture, there's probably within each of those, there's 100 or something. And so, but for purposes of this panel, what we want to do, given all the discussion you had yesterday and what is also going to happen today, we just want to zero in on 3 things. There are 3 broad approaches to this. One is stablecoins, the second is tokenized deposits, and the third is central bank digital currencies. We have 4 of the greatest experts in the world here to talk about those things. But I want to zero in. What we're going to try and talk about in this panel is how can they address integrating into existing processes and functions for businesses and governments and other organizations, which is hard to do because there's a lot of existing infrastructure. And second, meeting the requirements of the regulators, which I think to be successful, this has to be well regulated. And that, to me, boils down to 2 big issues. There's lots, but 2 really important ones. Ensuring that they're not good for illicit use. That's a key thing. How do you prevent financial crimes from operating on these systems? And the second thing is, how can you manage contagion risk, including cyber, and all the other risks associated with that? You have a lot of operational risks associated with this. It's brand new. And it's a lot of money. So how do we ensure that that works effectively? Those 2 things, plus how does it fit into the existing infrastructures? What we're going to talk about. Briefly, let me introduce our panel. Raj Dante to my left. Many of you heard him yesterday. He is definitely the most entertaining former regulator I've ever worked with. He was a senior policymaker. The first, I think, got CFPB off the ground, honestly, and went from 12 to 1,200 people. He also worked at Capital One and Deutsche Bank, and actually was a lawyer at one point, which is shocking. But he is a director of Circle, which is one of the contexts we'll be talking about today, plus several other companies. Umar Farooq is up there. I think really the most knowledgeable and expert person in the world, in my opinion, on tokenized payments, CEO of Onyx, and also co-head of the global payment sales at JPMorgan Chase. He also had other jobs, was head of digital wholesale payments inside the corporate investment bank, and he was also CFO for the CIB. Also a lawyer. Interesting. There's a lot of former legal practitioners here. And then Chris Giancarlo, is he up there? And let's see, he's supposed to be here. But Chris, many of you know, was actually succeeded. Okay, we cannot, but we'll work on that because we're going to get talk in a few minutes. But we can hear you, can't see you. Chris was succeeded Tim Assad, who spoke yesterday as the chairman of the CFTC. He is now he's head of the Digital Dollar Project. He's written extensively about central bank digital currencies, and he is also known on X as Crypto Dad. And last is Dante Disparate, who is the Chief Strategy Officer and head of policy at Circle, 20 plus years in risk advisory and insurance, and wrote a book on global risk agility and decision making, which sounds terrific. And so lots of reasons to be excited. Before we go into this, I'm gonna just give one example and a rule that I hope you remember, because as Jalapa said, I had a long career in payments, and I worked on the privatization of NASDAQ. I worked on the IPO of Visa, the IPO of First Data, and the IPO of Capital One, and the IPO of PayPal. So I have a lot of these, and I would say in my 40 years almost of working around payments, there are a few successes, but 99.999% of these ideas fail. There's no shortage of ways you could take technology and make the payment system better because it's evolved so dramatically and technology's evolved so dramatically. Why do they fail? Because it's really hard to say, I'm going to introduce a new debit settlement system in Europe. I say, good luck on that. Okay, because you got to get several 100 million accounts. You have to have 40 million businesses accept it. Impossible. And right now, it costs very little to do a debit transaction in Europe. So replacing that, not going to happen. But you can focus on transactions that do not happen, that don't exist. PayPal focused on little tiny merchants that couldn't get a merchant account, able to transact on eBay. They were sending checks before PayPal came up with their solution. Stripe, you were a tiny startup. You started your company 10 minutes ago. You can now start accepting payments. Square, you're a Boy Scout troop and you want to start accepting payments. They started with nothing. There was no solution. And then from there, you built a big ecosystem once you have a few million users. And that could be a platform that's very extensible and well-built and designed. So keep that in mind when we talk about what it takes to succeed, because I think being well-governed, being interoperable and having all the interfaces into the existing systems, those are all standard requirements. So I'm going to start by asking each company in 2 minutes, each speaker, to say, how does your product fit into the existing infrastructure today? What's the core use case in production now? And so let's start. Umar, do you want to start first live from Beijing?
Actually, I just made it to London. I had to fly to England last minute, but I am coming in from Beijing, so a bit jet lagged. But either ways, Hans, great to be here. I really appreciate being invited with this great panel. I'll talk about what we have in motion. So from our point of view, our primary goal has been to deploy distributed ledger technology and blockchain to upgrade our existing product set. So it's less about something that's new from a legal or product definition point of view, and it's much more about just making it better than what it used to be. So our primary product set is focused on digital assets as well as tokenized, essentially a tokenized version of deposits. And in that case, in both those cases, sorry, I think I have an echo, so I'm going to turn the volume down a little bit. Maybe that'll help. So in both those cases, what we are doing is we are basically deploying blockchain for deposit accounts that can move money across the globe 24/7. That's one of our primary products. But as you mentioned, the real value that we see is in programmability. So one of our cutting edge products is actually enabling our corporate clients use programmability to essentially set and forget money movement conditions. So they can trigger payments based on a variety of metrics, a lot of the signals that come from within the bank or things like FX rates or even external signals. And that essentially then translates to if this, then that sort of instruction. So you can execute these transactions. And these are large value transactions every day at any time. And we are at this point transacting in our product, a few $1 billion a day.
All right, Umar, thank you. Chris, do you want to discuss central bank digital currencies briefly?
Yes, and my apologies. I just got the link, and I've been struggling to figure out how to turn on this camera. So I apologize I'm not with you visually.
We can now see you.
With you.
It's not a great image, but we can see you.
Oh, fabulous. Well, hopefully you can hear me, more importantly. It's great to be with you. This is such a fantastic conference, and I've had the privilege of participating in the past. I'm delighted to be with you today. I'm going to speak on behalf of the Digital Dollar Project, which is a nonpartisan, nonprofit, non-political organization that believes firmly that the future of finance is a future of different systems of value. Some of them will be decentralized, like Bitcoin and Ethereum. Some of them will be highly centralized and operated by private sector entities like stablecoin operators. And others will be highly centralized and run by governments, such as Chinese digital yuan and the European digital euro. And the Digital Dollar Project exists to ask the following questions. What of the dollar in that digital network 21st century? How do we future-proof the dollar for that environment? How do we maintain the dollar's reserve currency status? And most importantly, how do we preserve the universal values that the dollar has historically stood for, such as free trade, free enterprise, and most importantly, free economic expression against both government and perhaps commercial digital surveillance, censorship, and control? So we begin from the point of view that a digitally networked future is coming, and we ask the questions for both public sector and private sector consideration of how do we project the dollar into that digital future.
Okay. Chris, can I just, one question, is there anything, there's nothing in production, obviously if it's digital dollars, there's nothing in production now, right?
The digital dollar project is not a commercial enterprise. It doesn't seek
right.
to.
But I'm just saying, as an observer, as an expert observer, there's nothing currently in production.
That's correct. Well, you might say stablecoins in production. There's nothing in production by the government, but private sector actors are making great strides in putting the dollar onto digital networks.
Okay, great. We'll come back to that. Raj, do you want to discuss Circle?
Sure. First of all, thank you again to our hosts here, and Hans, thanks for moderating this. My day job since leaving the CFPB has been mostly about investing in new financial services ideas. There's been I should probably know the actual number, but I do not. There's probably been 75 different investments we've made over time, exactly 2 of which have been around anything crypto related. One of which was called Ledger X, which they sold themselves to FTX in an all cash transaction. Thank goodness. And the second is Circle. I've been on the board of Circle for 11 years. Circle is a US-based money transmitter licensed firm that is the issuer of USDC, which is, let's call it any given day, $35 billion of outstanding tokenized deposits pegged to the US dollar. Also the issuer of EURC, sort of the similar idea, and the first Nyca licensed issuer in Europe in the new regulatory regime there. I'm going to pause there because at any given time in rooms like this, a third of the people are alumni of Circle. So I'll just I'll pause.
Well, we're going to dig into this in a little more detail, but I think from the beginning, I will make the comment that Circle, possibly because of your involvement, has taken the view that they want, even though they're not regulated, well, you are regulated by New York DFS, but you want the system to be regulated. It's been, and I think yesterday, BNY is your custodian. You use the financial system as part of the underlying premise.
Yeah, that's right. And it has been the premise since inception,
right.
Which is, a luxury that one can indulge in if you can raise a mountain of money from day one, which I will acknowledge is not available to everyone, but in my view is the only way to build a scalable business that will stand the test of time.
I agree with that. Okay, so Umar, we're going to go back to you, and I'm going to make a comment, which is I think it's 100% certain that all 3 of these protocols will play a role in the future of payments, and they're going to also coexist with wires and ACH and card schemes and a million other things that might come up. So what's the necessary infrastructure that's necessary for what I would say is seamless interoperability with the banking system, but also for non-banks, for companies maybe don't want to go through a bank? What infrastructure is necessary? How far away are we from that?
Okay, so first of all, I have to be a bit cautious because, Circle brought 2 people this time. So, I have to be, mindful of that because Dante brought some reinforcements. But either ways, I think jokes aside, I feel there's interoperability at different levels. So it's not just an infrastructure question, because the infrastructure actually, or technology, we can relatively easily resolve, because I think, Hans, I fully agree with you. These are just different means of transacting. So, we live in a world right now where you have M0 money at central banks and you have M1 with commercial banks. And then you have, actually more derivatives of money. You have the PayPals and the Venmos and the Zells, and there's various ways of people to transact. And so in a future state, you can see the same thing transitioning over to a distributed ledger world where you could have, stable coins, and you could have deposit tokens, and you could have CBDCs, and all these things would interoperate. I do think, though, you almost have to think about like at least three, and there's more dimensions, but let's think about like three primary dimensions. One is for some legal clarity on what the thing is. And I think especially in the US, and I know there's been various sort of legislation making its way up and down through, various parts of Congress, but in reality, just being clear about what the thing is helps. Is it e-money? Is it, some sort of, M2, M3, whatever it is? I think it just helps institutions, especially financial institutions, interact with different forms of things that might be out there. Then there's a general regulatory sort of setup, which again is connected to that question. And I think it's very important, as you said at the start, you need to make sure that these things are not more prone to bad actors. And I'm not sure that that is, by the way, the case. I'm just saying it out, in terms of that's something that has to be figured out, especially when you think about cross-border transactions and travel rule and things like that. I mean, we need to know, especially we need to keep bad actors out of the system to the extent we can, at least to the same extent that the current financial system does. But I think then you come to the more technological sort of questions of settlement and interoperability. And I do think that in my case, at least in my mind, is the easiest thing to solve. I believe there's many players out there, there's various companies, there's various exchanges, there's various sort of intermediaries that are making it easier for individuals to interact with this ecosystem. I think for financial infrastructure to interact, we, for instance, in JPMorgan, we have a product called PaySync, which essentially enables us to do a synthetic delivery versus payment product or a payment versus payment product with any other blockchain. So those things actually are the easiest ones in my mind. I think it's probably more the legal clarity and the regulatory clarity that's required for the interoperability to happen at scale.
Well, in fact, when it comes to CBDC, we already have data points. The Digital Dollar Project explored post-trade security settlement on CBDC with the DTCC, the first ever private sector initiative where we explored what a synthetic CBDC pilot might look like in terms of exploring how commercial banks could settle tokenized securities. And it worked quite well, in fact. And then we've also done a pilot for cross-border remittances with Western Union and found that it worked quite well there as well. So I totally agree with Umar. I don't think the gating issue is as much infrastructure as it's actually regulatory and policy clarity, and that we desperately need.
Yeah, I'm gonna challenge you a bit on that, and I also want to talk about AML, which is a key part of this infrastructure too. But I would say if you take many initiatives, and like ISO 20022, for example, which was proposed 10 years ago or something, and how many corporations have adopted it? Like, I don't know. You're at Sibos, Umar, but it's still very few. It's not a priority. Most treasurers don't get a lot of technology resources, even at Apple. And so changing around their infrastructure, for example, to optimize payment choices for measuring risk versus settlement, it takes a long time. And and adoption of anything, we could talk about the timeline on DTCC because I'm a big fan of that topic. And it was the QSIP, which is the Committee on Uniform Standards Information Processing, was established in 1962, and DTC went live in 1973. So it's a long time to get to where it's actually getting real volume on these things, replacing existing processes. But before we come back, we can come back to this because I think I want to talk about financial crimes, and the question I would put to Raj is, what does Circle think are the basic responsibilities of any participant, let's say a stablecoin issuer, for preventing illicit use? And can you also try and frame out the debate with what is the debate with the regulators on the scope of that, and how do you feel about it? Not just with Circle, but other entities too.
Yeah, I'm sure this answer will intersect with the point of view of Circle, but I would say more broadly, for anyone who wants to be a responsible guardian of financial infrastructure, here's how I would think about it. I think it's useful first to be honest about two things. Honest thing, the first, is that in the world that we live in right now, I believe that your conditional probability of being a bad actor is higher if you are involved in crypto. Like, I would like it if it were otherwise, but that isn't the world that we live in today. That's fact one. Fact two, listen, it's good to be smart and to do smart things. Once my daughter, when she was like 4 or 5 years old, said to me, you know, Dada, sometimes things just come to me. And I thought, yes, you're describing the experience of being smart. That must be nice. But it's also important to remember that you cannot, over time, you cannot count on outsmarting adverse selection. So in my opinion, the best things that a responsible player can do is twofold. One, demonstrate positive selection, at least the potential for positive selection through choice of jurisdiction and regulator. So in the case of Circle, you know, we are a US-based company. We were the first recipient of a New York DFS BIT license. We are, by virtue of our bank partners, you know, subject to their own risk oversight mechanisms. Second is through both the, I would say, the rigor as well as the visibility of risk processes to be able to signal to potential counterparties that we take these issues seriously. There are bad guys, and therefore being sensible and rigorous and visible about upfront KYC processes, having appropriately risk slope enhanced due diligence processes, an effective, hopefully efficient transaction monitoring system, all of this is core to the enterprise. And the useful thing, I think, at this moment in time is that if you're quite upfront and visible about it, you end up with most bad actors seeking other doors, which is useful. And indeed, were it otherwise, it would be hard to be confident about the sustainability of our approach.
So, Umar, I'm going to go back to you on this. What do you think, in the criteria you would have for interfaces with stablecoin issuers, are the standards different that you would apply than what they are today?
I do believe if you are thinking about money movement, you need to, at some level, know who the money is with and why they are transacting, especially in cross-border transactions. And I'm not sure, and I don't think it's a stablecoin issue. I think it might be an infrastructure issue because we haven't gotten to a good identity mechanism in many of these, what I would call many of these infrastructures. I mean, the underlying infrastructures, public ledgers, that is. So I don't even think it's a question of, you know, trying to effectively, you know, sort of subvert the law or avoid the law. But if you are operating in the crypto realm, stablecoin or otherwise, and you want to send something of value, again, USDC or Bitcoin or Ether or any of these things across borders, yes, you can monitor the two endpoints. And then in the middle, you have, you know, companies like Elliptic and Chainalysis that are monitoring the nodes. But the trail can be lost, akin to cash, where, you know, I know who takes the cash out of a branch, I know who brings the cash into a branch, but in the middle, I don't really know who touches it. And I think while crypto is probably better than that, because you can track it to some extent based on history of nodes and interactions and, you know, sort of statistical methods, but you have similar issues. And especially when it comes to large value money movement, what we've done with, you know, BSA and other sort of lawmaking over the last 50 years is if someone does walk in with a suitcase of cash into a US bank branch, you know, there's a bunch of paperwork you got to do. And in many of these areas, that's just currently not the case. So you can walk around with this thing for a while, so to speak. And I think that has to be somehow sort of synchronized. Again, I believe there's mechanisms to do that, especially in terms of verifiable credentials and distributed identity. It's just we haven't gotten there yet.
And
so we may want to come. Yeah, go ahead, Chris.
Hamza,
Yeah.
I was just going to see if I could. I'm from the private sector, and I'm here to help. I wanted to, if possible, just make a quick bridge to some of the comments that Cecilia shared earlier, and then related to this particular conversation, which is that you know, to talk about stablecoins, tokenized deposits, or central bank digital currencies. I agree with Chris Giancarlo. This is every bit the digital currency space race. But in some ways, thinking about what the tokenized asset is like designing a high-speed, you know, rail system or train, but only caring about the train and not the tracks. And I think what all of these types of product constructs would share in common is the notion that, number one, they have these, you know, globally available rails that allow for instant settlement, that allow for interactions across the banking system and in different geographies at the speed and scale of financial activity. A reminder that our financial needs don't take bank holidays. And then secondly, that this idea that these innovations would somehow introduce greater risk of the illicit finance variety, I want to double down on what Raj said at the outset, which is that if you design the financial integrity norms well, you actually achieve what I like to describe as a standard of effective deterrence. There's a lot of projects in crypto that sadly are using the anonymizing and scary and horrible side of the term of art crypto to effectively cater to illicit finance. But there's companies like ours, there's projects like what Umar is leading, and there's many others that are really showing a wholesale upgrade in combating illicit activity and making it really, really hard for bad actors to co-opt good technology.
Okay, I think I agree. We only have a couple more minutes. I want to make sure we cover the last question, Chris, which is how do central bank digital currencies, what are the benefits in preventing contagion risk and operational risk and even cyber risk versus the tokenized deposits or stablecoins?
I'll come to that. I can't resist, as probably the only senior regulator on the panel, of addressing the law enforcement issue, and we really need to, I think, rethink the way we go about curbing bad activity. The existing AML KYC system has dubious Fourth Amendment standing, but it really is a system that seeks identity before people engage in transactions in case they do something wrong. The beauty of this technology is it actually allows us to conduct law enforcement without having to take people's identity away, in many cases, law-abiding people, because what we can do finally, and something that I advocated doing during my 5 years at the CFTC, is to become quantitative regulators. By becoming nodes on blockchains, regulators, without having to identify every participant in the system, can use modern big data analysis tools and AI and others to monitor transaction flow and to look for probable cause patterns that demonstrate probability of law breaking, and then can first interdict the behavior and lastly gather the identity. So people can engage in commerce the way our Constitution meant them to engage in commerce, freely without surveillance by government, but only in the case where there's reason. Now, we may think that's so far.
Hold on, Chris. I'm sorry. It's an excellent point. I'm sorry to interrupt, but we only have 3 minutes left.
Sure.
So I do want to make sure. I think we're going to have to skip the question on contagion risk. So all of you will just have to imagine what contagion risk can be like and what the best solution is. But I do want to ask each of you, and this is important, a very brief, like 30 seconds. What is the most important objective in 2025, and Chris, I'm going to start with you, that policymakers should have, just policymakers, for 30 seconds?
I believe the United States has to realize that its single most important asset is the dollar. If we look around the world today, the greatest brand in the world is the dollar, even more than, say, Nike or McDonald's. The dollar stands for everything that the United States stands for. It stands for free enterprise. It stands for free financial expression. We need to think about how do we project the dollar and the world that relies on the dollar into the 21st century. Now, stablecoin operators we're discovering are satisfying a demand for dollars nobody even knew existed. And that's a spectacular thing. But we need to go beyond that. We need to think about how do we project the values of the dollar, its role as a reserve currency. And I think the most important thing policymakers need to do is get beyond this CBDC bad, private sector good, private sector bad, CBDC good, which seems to be between our political parties today, and recognize we have a collective effort, public sector and private sector, to project the dollar into this new digital world.
I agree. And I read your paper and you make that very clear. And so, Umar, what do you think is the single most important objective that banks should have in 2025?
In this technology, in this area?
Yes, just in digital asset technology, just next year.
I believe that they need to sort of face the fact that this could be a pretty big, sort of change in how the ecosystem works, especially if public ledgers become more meaningfully used by corporates and by individuals. So I think they should be very prepared to utilize that tech if we get there from a regulatory point of view and from a legal point of view.
Okay. And Dante, what is the single most important objective for corporations in 2025?
The simple answer is lead or be led. I think we won't leave 2025 without US regulatory clarity for payment stablecoins to be brought into the financial perimeter. And I think every company in the world, just as every big bank in the world, is looking at blockchains as a part of the cloud infrastructure journey for money as well. And I think this genie's out of the bottle. Umar has proven it. Watch what they do, not what they say.
All right. We just got the stop sign flashed in front of us. That's all we have time for today. But thank you all, panel. Thanks to the audience. Thank you, Raj.